makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. Investors bidding for both stocks and bonds on both sides of the Atlantic. December's FOMC minutes put the spotlight on the pace of QT. Meanwhile, supply disruptions in Libya and rising tensions in the Middle East pushing oil just a bit higher. Blasts in Iran killing nearly 100 people, adding to the geopolitical turmoil. Plus, European inflation in focus, consumer prices rising in France, those moving higher as well. German CPI likely to have done the same in December. We're going to bring you the data live in just a few minutes and get you that instant analysis. But before we do, a quick check on those European markets map, because again, remember, it is still very light trading volume. So when you're talking about what is actually moving right now, it's a little bit of everything. But again, the margins really matter. You are seeing green on the screen, but I would call it a margin of kind of autopilot, essentially, when you talk about the European trade. Again, it is still only the first week back. Remember, the last few trading sessions have been broadly negative on both sides of the Atlantic. So perhaps just a little bit of rebalancing there, retracing, I should say, is a better word, as we go into whatever next week brings. In the meantime, we're getting some more breaking regional inflation data coming out of Germany. I want to get that instant analysis. Bloomberg's Oliver Crook standing by in Berlin. Ollie, walk us through the numbers.
Yeah, so what we're getting is sort of a follow-on from what we saw from North Rhine-Westphalia earlier this morning, which is a year-on-year figure that is quite a bit higher than it was last month. So we're coming in at about 3.5% in Hesse, 3.4% in Bavaria, 3.8% in Baden-Württemberg, and you take that with a 3.5 from North Rhine-Westphalia, that is going to be quite a bit hotter. However, when you go at the month-on-month figure, you're getting some contraction in some areas, you're getting some zeros, and you're getting some 0.1%. So overall, this doesn't sort of dislodge the direction of travel for inflation over in Germany. And you go and you see a similar story over in France, where we got the headline number of 4.1%. That is a very hot spot for the French economy. But again, you go month on month, it only gained by 0.1%. And when you drill down into those French numbers, there were in fact only two categories where prices rose. That was in services and fresh food. And it's again a holiday month, so perhaps not a total shock. I think what's interesting, though, is the question in Germany is longer term. It is the only of the four major economies in Europe that is not expected to hit that 2% target by 2026, so still quite a way out there. And really, on top of all of that, all of the headwinds in the German economy, we're expecting a technical recession at the end of last year. I think GDP actually in Germany is going to be more important than CPI.
Talk to us about the translation of what this means for the ECB here. Does this change their strategy? You mentioned that we had on the month-over-month number 0.1%. But if you compare that to the last couple of months, you did have negative numbers in the last couple of months. Should the ECB be worried at any point?
It's true. I think that broadly speaking, however, the narrative stays more or less intact in terms of prices coming gradually into line with that 2% target from the ECB. What we're expecting for December is 3%. Yes, that is higher than 2.4%. Yes, it is actually the first acceleration in inflation in about 8 months in Europe, because the trend line has been solidly downward. However, we got to keep a couple of things in mind. For one thing, that November print was very weak. It was 2.4%. It was much weaker than most people had anticipated. So maybe the ECB scores a bit of a loss in December that offsets the gain over in November. The other thing we need to keep in track of is that we're considering actually core is going to go down just a little bit, and core is what has been the real driver here. So that spread between core and headline is going to come a little bit closer aligned, is going to narrow a little bit, which is really what the ECB is looking for. And again, Kriti, let's not forget, what we were looking at last year when we were breaking these numbers was 9.2% inflation in the Eurozone. So really, we've come a very long way. I think the issue is going to be that last mile for the ECB. Getting to 2% might be the longest.
Certainly something we're going to keep an eye on as we talk about whether or not Europe and the European central banks can actually catch up with what you're seeing in the rest of the world. Bloomberg's Oliver Crook there breaking down those numbers. I want to get a little bit more analysis, though, build on what Ollie was talking about. Erik Nelson joins me this morning. He's a macro strategist over at Wells Fargo. Erik, we just got that data that Ollie just broke. We're talking a little bit about the translation or the read-through into the ECB as well. But at a time when European economies are clearly struggling by a bigger margin than their other G10 counterparts, does that mean we're going to start to see a bigger divergence between the Fed and the ECB?
Well, not necessarily, Kriti. And I think the big difference here is the ECB has a single inflation mandate, whereas the Fed has a dual inflation and labor market mandate. And the ECB historically has been known to, let's say, take a little bit longer to ease, or in many cases even tighten late in the cycle. I think this time around will be relatively similar in the sense that the ECB will be slower to cut than many think. Now, we think the Fed will start cutting around, say, May, June, think the ECB will be on a relatively similar timeline, relatively speaking.
But you said slower to cut. Where is that coming from, though? What's driving that? Is that a question more of that inflation still is going to be a problem that sticks around, or that there is some element of European resilience? Why that call?
It's more about inflation, I think, is really the key. And inflation's a lagging indicator, right? And so are wages. The ECB has talked about wage growth as being a concern, those second-round effects. You can debate all day whether or not these affect inflation and whether or not they're real, but the ECB is clearly worried about them. And I think until the Fed makes a clear, decisive turn toward cuts in terms of actually delivering them, not just talking about them, I think the ECB will be hesitant to be the first mover on the rate side when we go lower.
So before the holidays, you were right here on set with me. We talked a little bit about your euro-dollar forecast. Let's revisit that. 2024, your euro-dollar call.
Yeah, so in the near term, we do think that it continued to drift higher a little bit in the sense that Fed's moving toward cuts. Yes, the European economy is certainly weak, but some of that's already incorporated. And I think as we get into the middle of the year, though, we'll start to see that fade a little bit. We do think euro-dollar drifts back down towards, say, 105, 107 on global economic weakness. We have a recession forecast for pretty much all the major economies. That tends to be very dollar positive historically.
So this is at its core, though, a dollar story as opposed to a euro story.
That's right.
But what does that then mean in terms of the data that we're actually looking at? You talked about the emphasis on inflation, and to your point, the ECB doesn't have that dual mandate of full employment that the U.S. has. But I'm curious about whether the labor market is still relevant at a time when, to your point, wages are still driving the inflation narrative.
Absolutely. I think that the big difference with the Eurozone labor market is it tends to be more inflexible and slower to react than the U.S. labor market, right? You look at German unemployment during 2008, 2009, for example, barely moved. It's more or less a blip on the radar, whereas you saw, a 4 or 5 percentage point move in U.S. unemployment. So I think it's hard for the ECB to even, in theory, have a labor market mandate when it moves so slowly and tends to lag so much relative to the U.S. labor market.
I'm curious about what you think in terms of the liquidity story. We've been talking a lot about it this morning in particular. Post the FOMC minutes, suddenly a renewed focus on things like quantitative tightening, for example. But I'm curious if that means that you are going to start to see liquidity issues actually show up to a greater extent, not just in the United States, but right here in Europe. Well,
I think there's a couple of things that strike me on the liquidity story. One would be people view the liquidity story and what the Fed's doing on QT as sort of a second signal on interest rates, right? To the extent that the fact the Fed is talking about dialing back QT, it's not a coincidence. They're also talking about rate cuts, right? So these things go hand in hand. I think the other thing that stands out is, the Fed being preemptive and potentially ending QT before there's an issue. That's a change, right? Usually they kind of just push and push and push, wait for something to break, and then they'll react. But I think this potential shift toward more preemptive, proactive change, that would be, I think, very dollar negative and I think push rates lower overall. When you talk about pushing rates lower overall, though, there is still that question of how much supply can actually be digested in this market. Some might say, well, if the Fed is going to pull back on their balance sheet a little bit, or at least on the quantitative tightening process, and ease that, it's going to kind of crunch the supply you see in the market, which could even incentivize the Treasury to perhaps raise even more. Is that something that would be welcomed by market makers? I think so much really depends on the economic backdrop. I think you saw this Treasury supply narrative really only become a narrative as rates were rising really aggressively. Suddenly people looked and said, why are rates up? Well, maybe it was the supply. I think maybe it was a little bit of a red herring or something that was overplayed to some great extent, especially as most of the issuance was really in the bills in the short term. Yes, there's a lot of issuance to digest over the next couple of years. That can put something of a floor under rates. But if the U.S. is headed for a recession, the supply narrative becomes much less relevant. But then what drives that U.S. recession narrative? Where does it come from? And I put this in the context of some commentary actually from our Bloomberg economic staff. Anna Wong, she's our chief U.S. economist. She made the point that historically rate cuts have come far before the labor market has demanded it. So if you're talking about rate cuts in 2024, I think 5 are priced into the market right now. Are we talking about them as an insurance cut, which is what Jay Powell did under the Trump administration back in 2019? Or are we talking about it as more of a necessity to keep the economy alive? Well, they almost always tend to start as insurance cuts, right? Even in 2007, the Fed was cutting well before there were real significant economic ructions. There were some financial ructions. Yeah. We're not really seeing that right now. I'd say the labor market is definitely weakening. It's not falling off a cliff. I think it warrants rate cuts. But for right now, these are insurance cuts. The Fed knows they can't wait for the recession to take hold. They have to get ahead of that. At some point, it could become more of, okay, we're panicked. We're trying to catch up, but we're not necessarily there yet. For now, these are preemptive.
How much power do they actually have right now, though? And I'm putting this in the context, again, of the fact that there's so much money parked in on the front end of the curve. There is a line of logic out there that basically says the markets are more directly in charge of the economy than the Federal Reserve is. And that is a scary thought when you talk about the bond volatility we've seen in the last 12 months. We're talking about rate cuts that are priced in. Should they be either insurance cuts or one that serve more dramatic deceleration in the data? Are the markets more in control here?
I think the markets are just reacting to the Fed, ultimately. The Fed is the one setting rate policy, right? And yes, the markets are probably a little bit ahead of themselves on where Fed cuts are priced. But to be fair, the Fed has clearly leaned into cuts. And look at the December dot plot, the December communications. They've maybe tried to lean against it a little bit recently with maybe the minutes and some follow-on commentary. But read through the noise here. They're going to cut rates, right? And so I don't think the market's necessarily more in control in the sense that the Fed's the one setting policy and the one communicating they're going to cut rates, and that's what's really driving things here.
Well, they're setting, sure, the Fed funds rate they're setting, but the actual mechanism that influences the economy, I mean, you're no stranger to this. When you're talking about even break-evens pricing, that has a very real impact on inflation in the real economy. It affects, the average American's pocket, basically. So I'm curious then, if the market is front-running the Fed, as you've suggested, does a lag even matter in the conversation of whether or not there is one?
Yeah, I mean, I think that what strikes me about the narrative is that I think it puts a little bit too much emphasis on what we call financial conditions, which tend to mostly just reflect stock prices. And then in terms of how quickly these short-term rate moves feed into economic decisions, we talk to a lot of business leaders, CEOs. Sure, some are looking at the day-to-day movements of the 2-year and the 10-year Treasury yield. Most are just looking at things over a longer time frame. They're not looking at week in, week out, what's the 2-year doing. So I think it does tend to have more of a lagged impact and more of a broad impact spread out over time than I think people give credit for on Wall Street.
You might get some pushback on the stock market influence financial conditions.
Sure, I will.
They'll get cringed a little bit the minute you said it. Anyways, Erik Nelson, we have to leave it there. He's a macro strategist over at Wells Fargo, walking us through just how much power the Federal Reserve has in this environment. We thank him, as always, for joining. But a big part of that conversation is going to be what happens in the geopolitical landscape. Remember, you have U.S. elections, but you also have a lot of rising tensions in the Middle East that could impact not only the inflationary narrative, but how the Fed even navigates it. Of course, that's where we're going to go next. Blasts in Iran killing nearly 100 people. We're going to dive into the details next. Stick with us. This is Bloomberg. Blasts in central Iran have killed nearly 100 people, adding to risks between the war in Israel and Hamas. It's widening now potentially into a broader regional conflict. It all comes as more than a dozen countries warn that Iran-backed Houthis against further attacks in the Red Sea. I want to get a little bit more context on this developing story. Roz Matheson, our EMEA news director, is all over it. Roz, this happened around the grave of the former general commander of the Iranian Revolutionary Guard, which, from an American perspective, was something that President Trump has been very vocal about as a point of pride in having when it comes to his foreign policy and the way he's tackled Iran. It's a really sensitive issue around the world, the location of these attacks in particular. What more do we know about it?
Well, there's not much we do know because we're relying on Iran for a lot of the information. What we do know is that these blasts killed about 100 people, injured several hundred others. We don't know who was gathered at that site. Of course, it was to mark the 4-year anniversary, as you said, of the death of General Soleimani in a drone strike by the US. So there could have been quite high-level Iranian officials there. We just don't know who was actually killed so far in that attack. And Iran is actually sort of criticising Israel for it, but not overtly blaming Israel or the US for this attack. That's something that they're yet to do, and they may not even choose to do so. But it's very embarrassing for Iran in a way that this attack happened. So it will mean they have to retaliate in some sort of way. And is that directly against Israel? Is it more via their proxies? Of course, they've got many of those in the region. Is it via Hezbollah? Is it via the Houthis? Do they do something in Iraq? But they're going to have to feel the need to respond in some fashion to this. At the same time, even Iran seems to be aware of this risk of broader escalation escalation and not necessarily wanting that to happen. And so we'll probably see some sort of calibrated response that's not directly targeted at Israel or the US.
It's interesting that we talk about this as well, because we know Iran had also sent warships to the Red Sea as well. So even though it does originally seem like perhaps they might use their proxies, perhaps even getting directly involved is on the table. As we're speaking, though, Roz, we are getting some breaking headlines here coming from CCTV. President Xi telling Iran that China is condemning the terrorist attacks and saying that China, quote, firmly supports Iran in safeguarding their security. Those are some pretty strong comments from China. Talk to us a little bit about perhaps the precedent and the support that Iran has around the world right now.
Well, it's interesting because China, of course, has been a supporter of Iran over the years and certainly quite interested in its own development in the region, and that's really about countering the US and its influence in the Middle East. So anything that plays to its advantage, of course, it's going to comment on. But for China, it's also this existential thing about it says its agenda is not to interfere in other countries' affairs, and it sort of comes in when other countries do so. And so that criticism for the attack is not that surprising from China, and to use that moment as a wedge again against the West, because you've got this grouping of China, Russia, Iran, other countries in the Middle East, sort of pulling them further away from the orbit of the US and using Iran in that fashion. And we've seen Iran, of course, in turn, sort of implicitly supporting Russia for its invasion of Ukraine. So it's a group of nations that all have the same interest, which is to sort of develop an alternate power base to the US. And so China's comments are about Iran aren't surprising. China does not want to get directly involved, though, at the moment in the events in the Middle East.
Yeah, it's a really dire situation, and we just covered the Iran story, but of course there's always the Red Sea component as well. You talked about the Houthi rebels, and I think there was some estimate or some consensus that by this point, a couple of weeks and now months into the conflict, we would see tensions ease in the Red Sea, and we've seen the exact opposite happen, to your point. Roz Matheson, we have to leave the conversation there, but we thank you so much for your reporting this morning. Plenty more to come. Stick with us. This is Bloomberg. Welcome back to the Pulse. I'm Kriti Gupta, filling in for Francine Lacqua. Morgan Stanley's executive chairman and former CEO, among those expecting the Fed to cut rates this year. We spoke exclusively with James Gorman on his way out. Take a listen.
First half of the year, I suspect nothing. Back half of the year, they could easily move a couple of times. We started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
Morgan Stanley's executive chairman and former CEO James Gorman there, speaking to our Wall Street correspondent Shonali Bassick. In the meantime, sticking with the financial space, Bloomberg has learned that crypto asset manager Grayscale Investments is in talks with firms including JP Morgan and Goldman Sachs for them to potentially play a key role in its proposed Bitcoin ETF. The bank's being considered to be, quote, authorized participants, basically meaning that firms have the power to create and redeem shares of the fund itself. This all comes as Grayscale looks to convert its Bitcoin trust into an ETF. Bloomberg has also learned that some of the biggest hedge funds ended the year with double-digit gains in what was a pretty challenging year of 2023 for investors. Sources saying that Ken Griffin's main Citadel Wellington fund posted a 15% return. Izzy Englander's Millennium gained about 10%, and multi-strategy funds averaged just under 5% growth through November. All that data coming from Pivotal Path. Now over to the tech space. TikTok is aiming to grow the size of its U.S. store to as much as $17.5 billion this year, all according to people familiar with the matter. It's an expansion of the social media's e-commerce business, which would put them as in direct competition to Amazon. Now, TikTok Shop, which melds online entertainment with impulse buying, lets users browse items while scrolling through its feed of short videos and live streams within its main app. I want to stick with the corporate space here and talk about two major stories to put on your radar here, starting with Next. They've raised their profit forecast for the 5th time since June, saying it's going to grow even more next year after the British home and clothing retailer thrived during the Christmas shopping season. So those shares higher by about 5%. But on the downside, you've got JD Sports slashing its profit forecast, blaming unseasonable weather and cautious consumer spending for pretty weak sales during the crucial holiday period. You can see those shares taking a massive hit down about 21% in the European trading day. Coming up, a special focus on UK politics and what's widely expected to be an election year. We're going to unpack the biggest challenges for the Prime Minister. Stick with us. This is Bloomberg.